Coming up in today's show, stocks start a busy week higher, a look behind the bond market crash, the latest from the Middle East, Tesla drops 5%, and the UK plans to regulate the crypto industry. Hey, what's up guys? Hope you're all doing well. Welcome back to the Click Capital channel. And it was a bit of a bullish start to the week here. Pretty much every indice and sector finished up in the green, led by mega cap tech once again, all except Tesla, which came off a bit, and a few of the semiconductors were down. Other than that, we saw good rallies in the financials and some of those beaten down consumer staples, along with the industrials as well, with GE up 3.2%. And we'll start off by looking at the S&P 500 on the daily chart here, finishing the day up 1.2% to 4166. At this area of support we've been watching, and a few of my custom indicators are firing off bullish signals here. So the market could be in the process of putting in a short-term low here, but stick with me because I'll come back to the charts a bit later on. So there's a few reasons why the market could be getting bullish here, with a lot of people expecting a year-end rally. And research house Raymond James gave 5 reasons why the S&P 500 should rally into the end of the year, with the first being the end of the Fed's tightening cycle. So that's something stocks are really getting excited about. If the Fed doesn't keep on hiking, then that keeps consumer and business borrowing at a known level and helps the relative yield on equities versus bonds. And with that, they're expecting the soft landing with inflation coming down, which would actually allow the Fed to lower interest rates next year, which is further supportive of stocks. The third point they say is solid mega cap tech earnings, which apart from Apple, pretty much all the others are still growing pretty good, 7, 8, 10, 15, even up to 20% year over year in key metrics. Their fourth reason is year-end seasonals, and going into the end of the year, especially on a year that's already been up, is typically a good time, and especially in the fourth quarter of a pre-election year with an incumbent in office is pretty much always bullish. And their fifth reason is bearish sentiment, which is a contrarian signal, as we have been a bit technically oversold for the last few weeks. Wharton professor Jeremy Siegel shares the same sentiment that we're in for a year-end rally, as he thinks bond yields are near their peak and valuations look persuasive. He said the end of the historic sell-off in bonds is in sight, the Fed's going to leave rates unchanged, and he's also pointing to year-end seasonality, and like a lot of people, he's saying the 10-year bond yield is pretty much near the top. Fundstrat also says there's a number of catalysts in the bond market and economy that could get stocks breaking out of their doom loop starting this week, and it is a bit of a busy week. We've got a bunch of economic data, manufacturing services, the big one on Friday, the monthly jobs report, and of course the Fed is meeting on Wednesday to decide on their interest rates, with it being a foregone conclusion that they're pretty much going to stay on hold. Yields moved up a little bit again today on the back of the Treasury announcing a slightly lower than expected $776 billion in borrowing needs for the fourth quarter, which is still $3 trillion annualized, almost 10% of the outstanding federal debt at $33.5 trillion, and that was only $76 billion less than what we had expected a few months ago. And there's a look at the 10-year government yield, just climbing a bit today to 4.88 and firming a little up the front as well on the 2-year, now sitting at 5.04. And so even though Treasury Secretary Janet Yellen is saying long-dated yields are rising due to strength in the economy, there's a lot of evidence to point that the market's becoming more and more concerned about the ballooning US federal debt and the repayments on that now, given how high rates are and they're accelerating borrowing, spending, and Treasury issuance. And this article shows 4 charts to kind of put that into perspective. And here's one showing the huge growth in US government debt since the end of World War II, and currently over $33 trillion. That's larger than the size of the Chinese, Japanese, German, Indian, and British economies combined. And the US's debt to GDP ratio has passed a key threshold of 100%, and that kind of marks the point where a country might have to start worrying about its budget deficit dragging on overall growth. And we can see here in this world map, there's only a handful of countries that have a debt to GDP ratio over 100%. However, there are 2 countries above the US, Italy and Japan, with more debt relative to their GDPs. And Japan's famously been borrowing and printing money for the best part of 30 years now, and with their economy and stock market being a bit of a zombie in that time as well. And so there's talk of bond vigilantes, which is basically big institutions and funds selling down bonds and contributing to the spike in yields. And even with the conflict in the Middle East, we didn't see that flight to safety to treasuries, it's more been in gold. However, some are saying now it's time to stop crying about bonds and buy them instead, as one can now easily earn 5% in short-dated government bonds, money market funds, and 6% and higher in investment-grade corporate bonds, and towards 9% looking at high-yield junk bonds. And looking at the Google Trends chart for the search term TLT ETF, the most popular bond market ETF, has actually been getting record search interest on Google, the highest they've ever recorded over this last month, as the price has been absolutely smashed. Starting last month almost at 96 and getting down to 82 just a week and a half ago. Still trying to put a bottom in here. Got a bit of a bullish divergence on the DSI, not really showing any divergence on the hidden divergence indicator. You can see we're coiling up a bit here, and a lot of people are calling the bottom in the bond market here on the back of Bill Ackman covering his treasury short. One area hedge funds are betting more and more on, and something I've been bullish on for a while now too, as my regular viewers know, is uranium, which up until a couple of years ago had been on a downtrend, especially after that big accident in Japan we saw back in 2011 with the reactor meltdown, and then after Russia's invasion of Ukraine and Europe realized how leveraged and exposed their energy needs are towards Russia. Their interest in using uranium as an energy source is going through a bit of a resurgence, because when done right, it is a really efficient, clean source of energy. And just looking at the uranium ETF, URA, it's had a pretty good year. It's up about 30% year to date, and it's taking you out to a long-term monthly chart. You can see how beaten down it's been ever since the Fukushima accident back in 2011 in Japan. However, it appears to have bottomed out in COVID March 2020, and the price has more than doubled since then, and I still like it here long term as a secular bullish trend. Staying on commodities, we saw oil finish lower today and hasn't really spiked all that much since Hamas militants launched their surprise terrorist attack onto the Israelis, as there's been no physical disruption in the global supply of oil. And apart from what's going on over there, we have seen demand pull back a little bit from consumers at the pump, and we've got the price of crude here sitting down the bottom of the support range, currently at $82.50 a barrel. But there's still risks from Iran-funded militant groups and the Iranians themselves from escalating this war, as they said they would respond to an Israeli invasion of the Gaza Strip, which looks like they've already started doing, moving into the northern area of the Gaza Strip, and they seem determined to go in there and flush out every single last militant and try and rescue some hostages as well. And that's what's got the World Bank saying crude oil prices could soar 76% if the Israel-Hamas war morphs into a regional conflict. They also said other commodities such as industrial metals and food will also gain, and they expect crude to average $90 a barrel for the current quarter. And if we can avoid a regional conflict, then the price of crude should keep falling next year as demand declines, they say. Otherwise, as they point out, the current setup over there does share some similarities with the Arab oil embargo in 1973 after the Yom Kippur War, when several Arab countries attacked Israel. Moving on to other news, we saw Tesla shares get hit hard today, down almost 5% after some updates from Panasonic, Tesla's long-standing partner and battery cell supplier, grew some concerns about sluggish demand for electric vehicles once again. And so the sentiment on Tesla's turned a bit negative a bit quickly since last earnings. Elon Musk was really somber on the call, and results came in a bit weaker than expected, and a bit of a big compression in their operating margins, as they have been cutting prices to try and keep inventory moving along. And the market was getting a bit excited with Cybertruck release. However, that's been pushed back a bit, and Elon even said, "I just want to temper expectations for Cybertruck. It's a great product, but financially it will take a year to 18 months before it is a significant positive cash flow contributor." And the price action in Tesla shares has been negative as well. We saw that after the recent earnings report, they dropped down, gapped, finished about 10% lower. Then we broke through the support, and like I said last week, there's a high chance we'll be trading under $200 this week, and we've finished Monday here at 197.36. The next big area of support is that earnings gap from Q4 earnings in late January, which is around that 145 level, and I've got a feeling we could fill that gap at some point over the next couple of weeks or months, as Tesla pretty much always exceeds expectations on earnings. However, their last one, EPS, came in almost 10% worse than expected, and at $627 billion market cap. If the market really starts viewing this as just an automaker with compressing margins, then it still has room to fall on a valuation basis, as Tesla is still valued more than the entire auto industry combined. And moving on to Bitcoin, we got news out today. The UK government is confirming plans to regulate the crypto industry over there with formal legislation, with them aiming to introduce laws for the industry before Parliament by 2024. And that's another step in the right direction for the industry to try and bring some clarity of rules with the big economy. And just looking at the price of Bitcoin, still hovering right below that big resistance level of 35,000, maybe forming a bit of a bull flag here. And just looking at the weekly chart, that's the next big level for it to break out of. Over to economic data today, got inflation data out of Spain coming in a little softer than expected, 3.5% year over year growth. Germany inflation coming in at 3.7% year over year, and their GDP growth coming in a bit better than expected, but still contracting 0.3% in a sign of stagflation. Not much else out today. A few hours for now, we got the interest rate decision from Japan, a bit more inflation and GDP data from Europe tomorrow. Got some manufacturing data coming on Wednesday, along with the Fed's interest rate decision. Thursday, jobless claims. Then the big one Friday, non-farm payrolls, with economists expecting the economy to have generated 180,000 new jobs in October. Mark is saying there's 98.3% chance the Fed will hold on Wednesday, but about a 1 in 4 chance they may hike in December, and about a 1 in 3 chance they may hike in January. Got a little bit of a bump up in the fear and greed index today, but still pretty soft here at 31, and not much activity from corporate insiders. Didn't appear to keep buying the dip on Friday. And just going through the charts here, got a little bit of a bounce in international stock indices to start the week off, with China climbing again. Volatility came off a bit today with the VIX at 19.7, and a little bit of a pop up in breadth, but still really depressed here. Not even 14% of stocks above their 50-day average. There's the growth versus value stock spread, still sitting at the 50-day. There's a look at the spread of high yield bonds versus treasuries, still on a bit of a solid downtrend here, and a sign that risk sentiment's coming off of this market. But we've still got a strong short-term uptrend in inflation expectations. So dollar pulling back a little bit today, just under 106, and with that move down in crude, brought the whole commodity index back below its 50-day. And over to stock sectors, mostly green out there today. Cannabis stocks with a loser again, really technically oversold here, minus 16 on my DSI. Third consecutive reversal signal, and we'll be looking for this area to hold as support, as the market seems to have given up hope on the politicians doing the right thing in passing cannabis legislation, with the new House Speaker being a known anti-cannabis advocate. Plus, we're still waiting on the DEA to see whether they are going to reschedule cannabis or not. The other sectors down today were semis, clean energy, oil and gas, and gold miners, with the winning sector being transports, getting a bit of a bounce here after we got really oversold last week on the back of those UPS earnings. Also finishing higher was communications, up 2%, and the airline jets still trying to find a bottom here. And same with the defensive sectors, healthcare, consumer staples, putting in a pretty good bullish divergence here on both my indicators, and utilities been holding up a bit better. There's BlackRock up 1.5%, a little bit of a hammer on Chevron after it got really beat hard last week on the back of their acquisition of Hess and weaker than expected earnings. The other big one this week is Apple. We got to hear their earnings on Wednesday. They finished a bit higher today. Microsoft looks to be trying to reclaim that earnings gap up from last week, and Google trying to find its footing after getting hit hard from their earnings last week, and NVDA trying to hold the neckline of this head and shoulders pattern. And Amazon had the best response to their earnings out of the pack. Gapped up after their earnings on Friday, and we managed to climb again today, almost 4%, finishing above the 50-day. It's Meta as well, looking to hold ground after its earnings sell-off, even though they came in with blowout numbers, and Netflix still defending its earnings gap from 2 weeks ago. And there's a look at UPS, looking to hold ground here after it got hit really hard last week. And a few jumps in the snack makers, Coke, Pepsi, and Mondelez. We'll get to hear earnings from them on Wednesday. And a few other old economy stocks climbing today. Macy's, 3M, AT&T, and Verizon finishing up 3.5%, along with the banks as well, trying to hold ground down here after they've been sold off a bit these last couple of weeks. Much like a lot of the market is trying to find a low here. And just looking at my institutional buying percentage indicator for the S&P 500, still in a neutral zone, 51.8%, and the S&P 500 oscillator climbing a little bit to 42, still really close to that oversold zone. And there's a look at the mega cap 8. Like NVIDIA, it too is trying to hold its neckline from this topping formation, and the Nasdaq itself bouncing a little bit today, but the next level or support's a little bit lower, around 333 on the Qs, and we've still got the Russell 2000 at the bottom of its support. So like I showed you at the start of this video, there's still a lot of people hoping for that seasonal year-end rally coming off this low that we can quite often see in late October. And so if we didn't finish high from here, I think that would be the first ever Q4 on a pre-election year with an incumbent in office that we didn't finish Q4 higher. It's not to say it's not possible, it's a first for everything. And these oversold conditions do make fertile grounds for a bit of a technical bounce here, but we really need to see some improvement in breadth because the momentum across the board is still largely down, and we'll just have to see how these earnings go. The biggest stock in the market, Apple, on Wednesday, whether that can gap up and hold like Amazon has, because we've been seeing some really negative responses to earnings like on Google and Meta. So we'll keep an eye on them. But apart from earnings, we'll see what the Fed has to say on Wednesday, and then the big jobs report on Friday will be the big influencing factors of the market this week. That's all for this Monday. Thanks for coming back to Click Capital, and I'll see you again tomorrow afternoon. Cheers.